Hey guys, hope you're all doing really well. Look, I just wanted to run through the rest of what happened on gold this week. There was one other opportunity that you potentially could have taken advantage of, and I'll quickly run through that. But first, before I do that, I just want to introduce the strategy for those that do not know the ICC strategy, which stands for Indication, Correction, and Continuation. If you have seen this before or you do know the strategy quite well, feel free to skip this part and skip to the section where I actually run through what actually transpired on gold for the rest of the week. So let's jump straight into it. So ICC is it's a trend-based strategy. ICC stands for Indication, Correction, and Continuation. And what you're wanting to look for in particular is either an uptrend in the market or a downtrend in the market. Now, what is an uptrend? An uptrend has essentially the characteristics of an uptrend is when the market starts with a low in the market, starts a low and a high in the market. Price then creates a higher low, higher high, higher low, and higher high. So we're looking for these particular characteristics for an uptrend. The reverse of that is this market starts with a high, then confirms a low, creating a lower high, a lower low, a lower high, and a lower low. So those are the characteristics of an uptrend and a downtrend. Now, where does ICC come into this? So if we're looking in particular at an uptrend, we need to also factor in the fact that we want to be marking out our charts on the 4-hour and the 1-hour time frame. So when we're marking up, focus on the 4-hour and the 1-hour time frames, and I'll jump into that when we run through the example. But first, I'll run through the uptrend characteristics. So we've got a low in the market, we then create a high, we then create a higher low, and it's called a higher low because it's higher than the previous low. That's why it gets that name. Price then makes a higher high. At this point in time, we're drawing our level of interest at the most recent high, or the previous high to the higher high, if that makes sense. So we want a low, a higher low, and a higher high. We draw our level of interest, and at this point in time, we've actually then the first phase of ICC has played out, which is the indication phase. So excellent. So if we don't have any of this here, we've now just determined that we're in the indication phase. So now price then comes back below our level of interest and back below the previous high. This is the second phase, which is the correction phase. So price breaks below this level and it comes back down to this area and it doesn't break this previous higher low. This is again further characteristics of an uptrend because this low didn't break this previous low, so it's a higher low. It's higher than this low and it's higher than this low. So this is again, we're in an uptrend. Then now at this point in time, price then looks to break above our level of interest and that previous high, creating the continuation phase. Now, right before this level, this is really important, once the correction phase, so we've got indication, we've got the correction phase, once the correction phase is complete, we then scale down to the 15 and the 5-minute time frames to confirm characteristics that support the overall trend. And this example that I'm running through, it's to support the overall trend, which is an uptrend in this example. So then we're scaling down 5-minute, 15, looking for characteristics again of an uptrend. So higher highs and higher lows. Price then breaks above this level of interest because we know that if we're in an uptrend, buyers were strong here. So we know that if price breaks above this level, price has the potential and highly probable that buyers will step back in and they'll take price back up to create another higher high. Now, where are we setting our targets? We've already sort of indicated that our entry is at this level here once we've confirmed the indication and correction phase. we're looking to take targets at the previous high, or at the top of the higher high here. Now what I do in particular, I take half my position off at the halfway line between the entry and the higher high, and then the remainder at the higher high area here. That's it, guys. That's as simple as it is. So the reverse of that is what we call a downtrend. So a downtrend, we start with a high in the market, we then create a low, we then create a lower high. It's called a lower high because it's lower than the previous high. Price then breaks below this level, creating the indication and also a lower low. At this point in time, we can draw our level of interest at this low, and that's perfect. So now we've got the first phase. We've got the indication phase. The second phase now is the correction phase. So the correction phase happens here. Price then breaks above our level of interest, and it doesn't break this previous lower high, and it creates a lower high because it's lower than this previous lower high. Okay, so now we've confirmed that we're very much in a downtrend. We've got a lower low and a lower high. That's exactly what we want to see. So now at this point in time, we're doing the exact same thing as we did when we're in an uptrend. Once the correction phase is complete, which is this phase here, the second phase, we then scale down to the 15-minute and the 5-minute time frames to find the characteristics that support the overall trend. And in this case, the overall trend is a downtrend. We're then looking to make target at the previous lower low here. In this instance, what I would do is I would take off half my positions at this halfway point between the lower low and the entry. And that's as simple as it is. So let's run through the other opportunity that was available on gold. So I've just pre-drawn this just so it's a little bit easier and so we can just run through it a bit quicker, so I don't want you boring you guys. So if we're looking at what sort of transpired quickly, we can see that the market for this point in time has just been creating higher highs and higher lows, which means that price has been in an uptrend. Now I think a lot of people thought that maybe gold might continue up to, break the all-time highs, but it's not about what you think, it's what you see. So what's really important here is we're just following structure and we're following price. And then if there's an opportunity based on the ICC, the system, then we look to take trades accordingly. So in this example, we can see price is making a higher low, creates a higher high. Price then comes back below our higher low here, which means that this could be a confirmation that price could be potentially in a downtrend. So that's the first key that we're looking at. So we're looking at, okay, well, price has broken the previous low. This now potentially means that we could be in a downtrend. But we can't just leave it there. We need further information to confirm the overall bias. So then price creates this first indication phase. It's breaking below this level here. So we've got our indication. Price then creates the correction phase, which is the second phase. Now if we look here, if we look closely here, price didn't break above this level here, did it? So we've got a high, a low, a lower high, and a lower low. So we can create, at this point, you can either draw it doesn't really matter, you can draw your levels there, or you can draw your levels there. I wanted, to be safe, I would have drawn probably my levels here, absolutely confirming that below this level we know that sellers were in control because we've created that indication phase and the correction phase. We know that definitely below this level, because of this indication phase, we know that sellers have the potential to take control here to drive price back below this level. So if we remember back from the chart here, or this drawing, we know that once we've created the indication phase and then we've created the correction phase, price isn't breaking previous highs. We then, once the correction phase is the correction phase is complete, so this phase here, we then scale down to the 15-minute and the 5-minute time frames to find characteristics that support the overall trend. So, indication phase, correction phase. So now let's scale down. I'm just going to put a little mark here just to sort of show you what, just to indicate essentially where we are in the market and what phase we're at. So let's go to the 5-minute time frame in this case, and oh wow, that's massive. But you can see what I mean. So that's the area where I marked out. So we're going to focus on that. So we know that this is the indication, right? We know that this is the correction, and now we've scaled into the smaller time frames, and now we're looking for characteristics of a downtrend. So what are the characteristics of a downtrend? We want lower lows and lower highs. So let's see what we've got here and see if we can find that. So we can see that price didn't break this previous high. Price then breaks down here, creates a lower high because it's lower than this previous high. Price then breaks below this level here, creating a lower low. This is a very good sign to say that we're potentially in a downtrend, and we could have the potential to follow suit all the way through to this targeted area down here. So what you could have done, once price came back above this level, so once it pulled back, creating another lower high right here. So we've got one lower high here, and then we've got another one right here. That's perfect. That's exactly what we've said. Based on the ICC strategy, we've confirmed that the characteristics of a downtrend on the smaller time frame are happening right here. So what I would have done in this instance, I would have then looked to take entries below this level of interest. So a short right here. And I would have had my stops probably not at this lower high. I always have my stops usually at the second lower high if I'm in a downtrend. So then we look to take profits at the overall targets would be down at this level here, and I would have how I specifically trade. I would have also let's just sort of draw that level here. At around this level here, I would have taken some profits off, or at least half the profits off, and then let the rest run. So that would have been an absolutely perfect trade. If we look at the drawing here, we can see that was a risk to reward of over 3 to 1. It was a 1 to 3.7, which is absolutely fantastic. If you did get that trade, very well done to you. Unfortunately, it didn't work out for me because I trade the London session. The London session is 3 a.m. Using the New York time zone. New York time zone at the moment is UTC -5. So the London Open would have been around 3 a.m., which is around this point in time. So unfortunately, I missed the move. So you're not going to get every single one, and you're better to sit on your hands than force a trade or get a risk to reward of less than 3 to 1. Ideally, you can do a 2 to 1, but I would recommend for those that are new, continue to aim for a 3 to 1 or higher. That's the best thing. And that's pretty much it, guys. There wasn't any other opportunity because obviously this was Friday. There were 2 other opportunities that I ran through in my previous video. If you haven't seen that one, feel free to look at that one. And that's it, guys. Look, if you did have any questions, feel free to write them in the comments section. If you did like this video, feel free to give it a thumbs up. And if you want to see more content like this, then hit the subscribe button. I'd be very appreciative. Also, just wanted to say again, a massive thank you. I've almost hit 500 subscribers, and I did not think that I'd be getting that many at all. The intention for me to make these videos was to journal my trades, to journal my my journey, and yeah, just to see sort of what happens, to hold myself accountable. And I encourage you guys to do the same. I think it's really important to journal. You know, it doesn't have to be, you know, 30 minutes. You don't have to spend 30 minutes journaling. Just write your thoughts down. I use just a notes, really simple, and I'll take screenshots and I'll document everything. My good trades, my bad trades, trades that I missed, like this trade in particular. I definitely journal that because it just reinforces what I know, and it's very helpful at the end of the day. But yeah, look, thank you again so much, guys. I really appreciate it. Again, if you did like that video, this video, please give it a thumbs up. And again, if you want to subscribe, that would be also amazing. Thank you so much for your time, guys, and have a great rest of your weekend. I'll catch you in the next video.